Imagine waking up one morning to find that the crypto wallet you've been using for years is now illegal in your country, or that the exchange where you hold your assets has been forced to shut down overnight, not because of a hack, not because of a rug pull, but because of a law passed in a government building thousands of miles away. That's not science fiction, that's the reality millions of crypto holders could face in 2026. And the wildest part? Most people in the crypto space have absolutely no idea how close we already are to that moment. Welcome back. Or if you're new here, welcome. You've landed on the right video at exactly the right time. We are living through what historians will likely call the Great Crypto Regulatory Era. Governments across the United States, Europe, Asia, and the developing world are no longer asking whether to regulate cryptocurrency. They're now asking how fast they can do it and how tight they can make the rules. In 2026, we are seeing the results of years of legislative debate, international pressure, financial system tests, and yes, high-profile crypto collapses finally crystallize into actual enforceable law. So here's what we're going to cover in this video. We'll break down the historical context that got us here. We'll explain exactly how these new regulations work in plain language, no law degree required. We'll look at real-world case studies showing how these rules are already affecting projects, companies, and everyday investors. We'll dig into the risks and controversies because, trust me, not everyone agrees this is a good thing. And finally, we'll look at where all of this is heading and what it means for you. This is going to be a deep dive, so if you want to stay ahead of the curve in crypto, and honestly, who doesn't, make sure you hit that subscribe button right now. New videos drop every week, and this is exactly the kind of content that could save you from making a very expensive mistake. Let's get into it. To understand why 2026 is such a critical year for crypto regulation, we need to take a step back, because none of this happened overnight. It all starts in 2008, when an anonymous person or group called Satoshi Nakamoto published the Bitcoin white paper. The idea was elegant and revolutionary, a peer-to-peer digital currency that didn't need banks, didn't need governments, and couldn't be controlled by any central authority. For the first few years, regulators barely noticed. Bitcoin was a niche internet experiment used by tech enthusiasts and, let's be honest, a few people on the dark web. But then something happened. Bitcoin's price exploded. Ethereum launched and introduced smart contracts, essentially self-executing digital agreements that could run entire financial systems without human intermediaries. ICOs, initial coin offerings, raised billions of dollars from everyday people with almost zero oversight. And by 2017, crypto was a global phenomenon that governments could no longer ignore. Most people don't realize this, but the regulatory story of crypto didn't truly begin with FTX or Terra Luna. It began back in 2013, when the U.S. Financial Crimes Enforcement Network, FinCEN, issued its first guidance on virtual currencies. That was the first crack of the regulatory hammer. Fast forward through the years, 2017. The SEC declares many ICO tokens are securities, triggering enforcement actions. 2019, FATF, the international body that sets anti-money laundering standards, issues the travel rule for crypto, requiring exchanges to share user data on transactions above a certain threshold. 2021, China bans crypto mining and trading outright. The U.S. infrastructure bill includes controversial crypto tax reporting requirements. 2022, the catastrophic collapse of Terra Luna wipes out over $60 billion in market value. Then FTX, one of the world's largest exchanges, implodes in spectacular fashion, costing customers billions and sending shockwaves through the entire industry. That FTX collapse was a turning point. It was the moment politicians in Washington, Brussels, London, and beyond said, "Enough is enough." The calls for regulation became deafening. 2023, the EU passes MiCA, the Markets in Crypto Assets Regulation, a landmark piece of legislation that becomes the most comprehensive crypto regulatory framework in the world. 2024, the U.S. sees significant movement on stablecoin legislation and the SEC's ongoing battles with major exchanges. The Bitcoin ETF is approved, bringing institutional money flooding in. 2025, multiple major economies finalize or begin enforcing their crypto frameworks. International coordination accelerates, and now we're in 2026. This is the year where regulatory frameworks stop being drafts and start being law, where compliance stops being optional, where the crypto industry, whether it likes it or not, begins to look a lot more like traditional finance. But here's where it gets interesting. Not all regulation is the same. Some of it is designed to protect investors, some of it is designed to control the industry, and some of it, critics argue, is designed to kill certain types of crypto innovation entirely. Let's break down exactly how these regulations actually work.
Okay, so let's talk mechanics. How does crypto regulation actually function? Because there's a big difference between a government saying they're going to regulate crypto and actually being able to do it effectively. Think of it like this. Regulating traditional finance is like managing traffic on a well-mapped highway. You know where the roads are, you can set up toll booths, and you can pull people over. Regulating crypto is more like trying to manage traffic in a city where half the roads are invisible. Anyone can build a new road overnight, and some of the cars can teleport. So, how do regulators approach this? There are essentially three main levers they pull. Lever 1. Classifying crypto assets. The first and fundamental question regulators must answer is, what is this thing? Is Bitcoin a commodity, like gold or oil? Is Ethereum a security, like a stock? Is a stablecoin a form of money that needs a banking license? Is a governance token a security because it gives holders voting rights and potential profits? This matters enormously because the classification determines which agency has oversight and what rules apply. In the United States, this has been a bitter turf war between the SEC, the Securities and Exchange Commission, and the CFTC, the Commodity Futures Trading Commission. The SEC has argued aggressively that most crypto tokens are securities under the Howey test, a legal standard from 1946 that defines an investment contract as something where you invest money in a common enterprise with an expectation of profits from others' efforts. By 2026, the U.S. has made significant progress toward a clearer framework that distinguishes between Bitcoin, widely classified as a commodity, and many other tokens, which face securities classification. In the EU, MiCA takes a different approach, creating specific categories: e-money tokens, asset reference tokens, and a broader category of crypto asset services. It's more comprehensive and arguably more workable. Lever 2. Regulating the on- and off-ramps. Here's something most people don't think about. Regulators don't necessarily need to control the blockchain itself to control crypto. They just need to control the entry and exit points. Exchanges, places like Coinbase, Binance, or Kraken, are the bridges between the traditional financial system and crypto. Regulate those bridges, and you've effectively put a checkpoint on the highway, even if the roads themselves remain uncontrolled. This is why KYC, Know Your Customer, and AML, anti-money laundering requirements, are at the heart of almost every crypto regulatory framework in 2026. Exchanges must verify who their users are, monitor transactions for suspicious activity, and report to government authorities. The FATF travel rule, now being enforced with much greater rigor in 2026, requires that exchanges pass along identifying information about the sender and receiver for transactions above a certain dollar threshold, similar to how wire transfers work in traditional banking. Lever 3. Stablecoin regulation. Stay with me because this next part changes everything when it comes to how crypto will function in your daily life.
Stablecoins, digital currencies pegged to assets like the US dollar, have become the plumbing of the crypto ecosystem. They're used for trading, lending, payments, and DeFi, decentralized finance, which is the broader ecosystem of financial services built on blockchain without traditional intermediaries. In 2026, stablecoin regulation is front and center globally. The U.S. Payment Stablecoin Act, which has gone through multiple iterations, now requires stablecoin issuers to maintain one-to-one reserves with approved liquid assets, obtain federal or state licensure, and submit to regular audits. This is huge, because if stablecoins become as regulated as banks, the entire DeFi ecosystem that relies on them faces an existential question. Can decentralized finance survive in a world of compliant, regulated stablecoins? We'll get to that controversy in a moment, but first, let's look at how all of this is playing out in the real world.
Theory is one thing, but what does crypto regulation actually look like on the ground in 2026? Let's walk through some concrete examples. Case Study 1, the European Union and MiCA. The EU's Markets in Crypto Assets Regulation, or MiCA, came into full force in late 2024 and is now the gold standard example of comprehensive crypto regulation. By 2026, it's providing some fascinating data points. Under MiCA, any company offering crypto asset services in the EU must obtain a CASP license, a Crypto Asset Service Provider license. This includes exchanges, wallet providers, and advisors. The result? Many smaller operators have exited the European market. They simply couldn't afford compliance. But larger, well-capitalized players have gained market share. Some argue this is exactly what the EU intended, a professional, institutionalized market at the cost of decentralization and small player innovation. Stablecoins face particularly strict rules under MiCA. Issuers of significant stablecoins must hold reserves with EU-regulated custodians and face volume caps. Tether, USDT, the world's largest stablecoin, faced significant friction with MiCA compliance, leading to a period of uncertainty for European traders. The lesson from the EU: comprehensive regulation is achievable, but it comes with real trade-offs in terms of market diversity and accessibility. Case Study 2, the United States, a complex patchwork. The United States, in classic fashion, has taken a far more complicated path. Rather than one comprehensive framework like MiCA, the U.S. has a patchwork of agency rules, court decisions, and emerging legislation. By 2026, several key developments have reshaped the American crypto landscape. 1. The SEC has won significant court battles classifying multiple major altcoins as securities, forcing projects to either register or restructure their token models. 2. The approval of spot Bitcoin and Ethereum ETFs, exchange-traded funds, has legitimized crypto as an investable asset class for institutions and retirement funds, dramatically increasing capital inflows. 3. Bipartisan stablecoin legislation has finally passed, creating a federal licensing pathway for dollar-pegged stablecoins and bringing major issuers under Federal Reserve oversight. 4. The IRS has dramatically expanded its crypto reporting requirements, making it mandatory for brokers, now defined to include many DeFi protocols, to issue 1099 forms tracking user transactions. The net effect in the U.S., greater legitimacy, more institutional participation, but also significantly more compliance burden for everyday users and projects. Case Study 3, the UAE and Singapore, the regulatory arbitrage winners. Here's something fascinating that's emerged in 2026. Not every country is trying to restrict crypto. Some are actively competing to attract it. The UAE, particularly Dubai through its VARA framework, the Virtual Asset Regulatory Authority, and Singapore through its MAS, Monetary Authority of Singapore licensing regime, have positioned themselves as crypto-friendly hubs with clear, workable rules. The result, a significant migration of crypto companies, talent, and capital to these jurisdictions, what the industry calls regulatory arbitrage, companies choosing to base themselves where the rules are most favorable. Binance, for example, has deepened its UAE footprint significantly. Numerous DeFi projects have incorporated in Singapore. Hong Kong, under a separate but similarly accommodating framework, has made aggressive moves to recapture crypto business post-China ban. The lesson here, regulation doesn't just shape markets, it moves them. Capital and talent flow to clarity and fairness, not necessarily to the strictest or most lenient regimes, but to the most predictable ones.
Case Study 4, Nigeria and the Developing World.
And we can't talk about crypto regulation without acknowledging the developing world, where the stakes are arguably the highest. In Nigeria, which has one of the highest rates of crypto adoption per capita in the world, the government has had an incredibly turbulent relationship with crypto. After initially banning bank transfers to crypto exchanges in 2021, then loosening restrictions, then arresting Binance executives in 2024 over alleged currency manipulation, Nigeria's regulatory approach has evolved significantly by 2026. The Central Bank of Nigeria now operates within a framework that attempts to balance financial stability with the undeniable reality that millions of Nigerians use crypto as a hedge against naira devaluation and as a lifeline for international remittances. This is the human dimension of crypto regulation that often gets lost in the policy debates. For someone in a wealthy country with a stable currency and access to banking, crypto regulation is an investment concern. For someone in a country with 30% annual inflation and limited banking access, it can be a matter of economic survival.
All right, now let's get into the part of this story that doesn't get talked about enough. Because while regulation brings benefits like investor protection, market stability, and legitimacy, it also carries very real risks and has sparked serious, substantive debate. Controversy 1. Killing innovation. The most fundamental tension in crypto regulation is this. Blockchain technology was designed to be permissionless. Anyone, anywhere could build on it, use it, or innovate with it. That openness is precisely what has generated so much value and so many breakthroughs. Critics of heavy regulation, and there are many thoughtful ones, argue that treating crypto like traditional finance fundamentally misunderstands what it is. Requiring a DeFi protocol, which is just code running on a blockchain, to obtain a financial services license is a bit like requiring the TCP/IP protocol that runs the internet to get a banking license. The concern is that excessive regulation will push development offshore to unregulated jurisdictions or underground to truly permissionless systems, making oversight harder, not easier, while stifling legitimate innovation. Controversy 2. Privacy and surveillance. Here's a question worth sitting with. How much financial privacy should you have? Most people, even those who have nothing to hide, feel uncomfortable with the idea of every financial transaction being monitored and reported. Yet that is effectively what comprehensive crypto regulation moves toward. The travel rule, expanded KYC requirements, and mandatory tax reporting mean that the pseudonymity that many early crypto users valued, the ability to transact without a financial intermediary knowing your business, is rapidly disappearing in regulated jurisdictions. Privacy coins, cryptocurrencies like Monero and Zcash that offer enhanced transaction privacy, have been delisted by most major regulated exchanges globally by 2026 under pressure from regulators who equate financial privacy with money laundering risk. Civil liberties advocates argue this creates a dangerous precedent, one where financial surveillance becomes normalized and where the government has near total visibility into citizens' economic lives. Controversy 3. Regulatory capture. Most people don't realize this, but one of the biggest risks of financial regulation isn't too little oversight. It's the phenomenon known as regulatory capture. This is when the regulated industry gains so much influence over its regulators that the rules end up serving large incumbents rather than the public. In crypto, there's a credible argument that heavy compliance burdens, expensive legal teams, licensing fees, complex reporting requirements disproportionately favor large, well-funded players like Coinbase and large institutional asset managers, while effectively shutting out smaller competitors, open-source projects, and startups. If the outcome of crypto regulation is a handful of large, compliant crypto companies that function essentially like banks, monitored by the same agencies with the same access barriers, then many would argue we've simply rebuilt the traditional financial system with blockchain branding. Controversy 4: International fragmentation. And finally, the regulatory patchwork problem. In 2026, there is still no globally unified crypto regulatory framework. The EU has MiCA, the US has its agency-based approach, the UAE has VARA, China has a ban, El Salvador still holds Bitcoin as legal tender. This fragmentation creates enormous challenges for global crypto businesses and users. An asset that's legal in one country may be illegal in the next. A token that's a commodity in the US might be a security in Canada. A DeFi protocol operating entirely on-chain might be legal nowhere and everywhere simultaneously. The FATF is working toward greater international coordination, and the G20 has endorsed a common framework for crypto regulation, but implementation remains deeply uneven.
So where does all of this lead? Let's look at the trajectory and make some educated projections about what the next few years hold. Prediction 1: the Great Compliance Wave. By 2026, we're already seeing the beginning of what I'd call the Great Compliance Wave. Major crypto projects are hiring chief compliance officers, legal teams, and regulatory affairs specialists. Projects that once prided themselves on being decentralized and ungoverned are restructuring into legal entities precisely because they have to. This trend will accelerate. Within the next 2 to 3 years, operating a significant crypto business without regulatory compliance in major markets will become functionally impossible. The projects that survive and thrive will be those that built compliance into their architecture early. Prediction 2: the DeFi challenge. Decentralized finance is about to face its most serious test yet. Regulators in the US and EU are increasingly focused on DeFi protocols, and the question of whether code can be regulated is going to be answered, one way or another, in the next few years. The likely outcome: a two-tiered DeFi ecosystem. Compliant DeFi, sometimes called CDeFi, that integrates KYC and AML at the protocol level, serving institutional users, and truly decentralized DeFi that operates in a legal gray zone, accessible mainly to technical users willing to engage without the safety net of consumer protections. Prediction 3: CBDCs as regulatory tools. Central bank digital currencies, CBDCs, government-issued digital currencies, are closely related to the crypto regulatory story, and their development is accelerating globally. By 2026, 130 countries are exploring or piloting CBDCs. The digital euro is in advanced testing. The Chinese digital yuan is in wide domestic use. The US is in active research phases. Here's the provocative but important point. CBDCs may represent the ultimate regulatory response to crypto. If governments can offer programmable digital money that's fast, cheap, and integrated into existing financial infrastructure, they remove much of crypto's consumer utility argument while retaining total control over monetary policy. The tension between decentralized crypto and government CBDCs may define the next chapter of this story. Prediction 4: institutional dominance.
The retail-driven crypto market of 2017 or 2021 is being steadily replaced by institutional infrastructure. Bitcoin ETFs have opened the floodgates for pension funds, sovereign wealth funds, and large asset managers. Regulation, by creating legal clarity, paradoxically accelerates this institutional adoption. The irony is striking. The technology designed to replace institutional finance is increasingly being adopted by institutional finance. What that means for crypto's original mission of financial democratization is a question the community will be grappling with for years.
All right, let's bring this all together. Here's what we covered today, and here's what actually matters. 1. Crypto regulation in 2026 is not a future event. It's happening right now. The frameworks are in place, enforcement is ramping up, and the industry is being reshaped whether participants want it to be or not. 2. The regulatory landscape is genuinely complex. It varies dramatically by country, by asset type, and by the type of crypto activity you're engaged in. The EU's MiCA, the US's multi-agency approach, and forward-looking hubs like the UAE and Singapore represent fundamentally different visions for how this technology should be governed. 3. Regulation brings both genuine benefits, investor protection, market stability, institutional legitimacy, and real costs, reduced innovation, privacy erosion, and potential market consolidation favoring incumbents. 4. DeFi, stablecoins, and privacy technologies are at the sharpest edge of this regulatory moment, and what happens to them in the next few years will fundamentally determine what crypto becomes. 5. The global coordination problem remains unsolved, and regulatory arbitrage, companies and capital moving to favorable jurisdictions, will continue to be a major market dynamic. Here's my take, and I want to be clear, this is an educational perspective, not financial advice. Regulation, done thoughtfully, can be good for crypto. It can remove the bad actors, protect everyday investors, and create the institutional trust needed for mass adoption. But regulation done poorly, captured by incumbents, hostile to innovation, ignorant of what makes blockchain technology genuinely valuable, could hollow out the most revolutionary aspects of this technology while preserving only the financial infrastructure branding. The crypto community's response to regulation, whether it engages constructively, builds compliance into its DNA, and advocates for smart rather than just less regulation, will determine which of those futures we actually get. The rules are being written right now. Who writes them and who shows up to influence them matters enormously. If you made it this far, thank you. Seriously. This is exactly the kind of nuanced, important topic that gets lost in the noise of price predictions and token hype, and I'm glad you took the time to understand it properly. Now, I want to hear from you. Here's my question for the comments. Do you think crypto regulation will ultimately help or hurt the long-term future of decentralized finance? And which country's approach do you think gets it most right? Drop your answer below. I read every comment and genuinely want to know what you think. If this video gave you value, please hit the like button. It genuinely helps this content reach more people who need to understand what's happening in this space. And if you haven't subscribed yet, now's the time. We cover topics like this every single week, and the next video is one you really don't want to miss. Speaking of which, if you want to go deeper on the MiCA regulation specifically, how it works, what it covers, and what it means for European crypto users, I've got a dedicated video on that linked right here. Click it, it's worth your time. Until next time, stay curious, stay informed, and stay skeptical of anyone who tells you this is simple. See you in the next one.